There are no crystal balls in investing. Okay, look, we all know that and we all hear it all the time, but there is data, and that data can oftentimes give us really good insights into the market and sometimes even what might lie ahead. To be clear, there are decades of data to analyze, and there are trends that we might be able to pick out of that data. Yield curves are one amazing way to get a good indication of where the markets are at any given time. And surprisingly, yield curve inversion analysis has shown really big correlations between recessions. Let's learn about this amazing tool that may help you predict recessions better for your investment decisions. Is the yield curve signaling a recession? Long-term bonds generally provide higher yields than short-term bonds. This is because investors demand higher returns to compensate the risk that they take on for lending their money over a longer period of time. Occasionally, however, this relationship actually flips or inverts, and investors are willing to actually accept lower yields in return for the relative safety of longer-term bonds. This is what's called a yield curve inversion. And this is because a graph showing the bond yields in relation to maturity is essentially turned upside down. Check out the chart next to me now. A yield curve could apply to any bonds that carry similar risk, but the most studied curve is for the United States Treasury securities. The most common focal point for Treasury securities is the relationship between the 2-year and the 10-year Treasury notes. The 2-year yield has been higher than the 10-year yield since July 2022, and beginning in late November, the difference has been at levels that we have not seen since 1981. The biggest separation in 2022 came on December 7th, when the 2-year was 4.26 and the 10-year was 3.42%, a difference of 84 basis points. Other short-term treasuries have also offered higher yields. The highest yield is in early 2023 when we saw the 6-month and the 1-year treasury bills. Okay, a quick side note for you. Although treasuries are often referred to as bonds, maturities up to 1 year are actually considered bills, while maturities of 2 years to 10 years are considered notes. Only 20 and 30-year treasuries are officially called bonds. Just a little side note for you as the investor. Now, can we actually predict recessions based on an inversion of the 2-year and the 10-year treasury note? Well, in reality, according to the data, the 2-year and the 10-year treasury notes inverting have preceded each major recession over the last 50 years, reliably predicting these recessions. And using this measure, the data has shown that a recession was likely to occur within 1 to 2 years from that inversion. A 2018 Federal Reserve study suggested that an inversion of the 3-month and the 10-year treasuries may be even more reliable of an indicator, predicting a recession in about 12 months. The 3-month and the 10-year treasuries have been inverted since late October of 2022, and in December and in early January, the difference was even often greater than the inversion of the 2-year and the 10-year notes. So now that we have some of that data, let's ask the big question. Is this based on weakness of the economy, or is this due to the inflation controls that the Federal Reserve is doing currently? Now, yield curve inversions do not actually physically cause a recession. Rather, they're more of an indicator in a shift in investor sentiment that may reflect underlying economic weaknesses that often then lead to a recession. Yield curves being normal in normal market conditions typically suggest that investors believe that the economy will continue to grow and continue to be positive. Additionally, they typically indicate that interest rates are likely to rise with the growth. In this scenario, an investor typically would want a premium to tie up capital for those longer term bonds, because the alternative is the opportunity cost that they might miss another investment opportunity during the period of time that their money's tied up in those long-term bonds. Okay, so the reverse. Let's talk about the reverse. Conversely, an inversion often suggests that investors see economic challenges that are likely to push interest rates down and typically would rather invest in longer term bonds at today's yields. This then increases demand for long-term bonds, and which then drives the prices back down as well as the yields on those bonds down. Bond prices and bond yields move in opposite directions. So the more that you pay for a bond that pays a given coupon interest rate, the lower the yield will be on that bond. Now, with everything in the current market environment, the current situation is not so simple. The Federal Reserve has rapidly raised the benchmark federal funds rate to combat the inflation that we're dealing with today. The Fed has increased the rate from almost 0% in March 2022 to 4.5% as of December. And the rate for overnight loans within their Federal Reserve system, these fund rates directly affect nearly all other short-term rates, which is why yields on short-term treasuries have increased so rapidly. The fact that 10-year treasuries have lagged the increase in the funds rate may indeed mean that investors believe a recession is coming. That is what we're going through with everything, is to break down the economic climate that we're in now and move through all the complicated data to get to what is actually at the core, is that the inverted yield curve is typically signaling that investors are bracing for a recession coming soon. But in this complicated environment, it could also be reflecting the confidence that the Fed is winning against the battle against inflation. And if the Fed wins the battle against inflation, guess what comes next? Lower rates over the next few years. And if you spend time tracking what the Federal Reserve is officially telling people and what their own projections are, this is directly in line with what they're saying. Most on the Federal Reserve Board see fund rates peaking at about 5 to 5.25% by the end of 2023, and then dropping slowly to around 4% in 2024, and then about 3% in 2025. While this is all multiple years out, it is good to see what benchmarks the Fed is using and what their estimates are for the future of rates, because after all, they are the ones controlling them. The good news is that we saw inflation slow somewhat in October and November, but there's still a long way to go to reach the Federal Reserve's target rate of 2% healthy inflation for an economy. The fundamental question that we should be asking is the same as it has been since the Fed launched its aggressive rate increases. Will it actually require a recession to control inflation that we're dealing with today, or can it be controlled without shifting the economy into reverse? So let's look at some other indicators of the big picture, and maybe even some forecasts as well. The yield curve is one of many indicators that economists consider when making economic projections. Among the most closely watched are the 10 leading economic indicators published by the official conference board. This includes data on employment, on interest rates, manufacturing, stock prices, housing, consumer sentiment, and several others. The leading economic index, which includes all 10 of these indicators, fell for 9 consecutive months through November 2022, and the conference board economists predict a recession beginning towards the start of 2023. Here's what's tricky. Recessions are not officially declared by the National Bureau of Economic Research until they are already underway. And the conference board's view would suggest that the United States may already be in a recession right now. According to the Wall Street Journal's Economic Forecasting Survey, a majority of economists believe the United States would enter a recession within the next 12 months. And out of all those economists that they polled for this survey, the average expectation was a relatively mild 8-month downturn. How's that for a crystal ball approach to get a whole bunch of economists to give their average and then tell you exactly when it's expected to start and exactly how long it should last for, according to a blended mix of some of the smartest minds in our country. Now, there are even more recent surveys of economists for the Securities Industry and Financial Markets Association, and what they found was something similar. The consensus between those economists in those surveys was a mild recession throughout 2023. So all in all, for now, the economy appears to be fairly strong despite the high inflation that we're dealing with, and with recent low unemployment rates of 3.7 and an estimated 3.8% growth rate for real GDP last quarter. Now, unfortunately, the indicators and the surveys discussed above do suggest an economic downturn within about the next 12 months. This would likely cause some additional job losses and other temporary financial hardships throughout our country, but A brief recession may be the necessary price that we have to pay as an economy to tame the rampant inflation and put the US economy on a more stable track for future growth of the long term. While this does leave some uncertainty to us, the investors, one thing is 100% certain today. In markets like we're dealing with in modern times, diversification is important now more than ever to hedge against the wild market conditions that we're seeing. My absolute number one way to diversify yourself against the stock markets and many of the other market forces is to invest in real estate. I can't say this enough, and I say it in every video. The best way to invest in real estate is to be an accredited investor so that you can access literally the best investment opportunities in the real estate market and possibly the world for some of these deals. I'm going to put up a video now that goes over everything you need to know about becoming an accredited investor so that you can access these amazing invite-only opportunities to invest into real estate funds and opportunities that you otherwise would not be able to. Check out the video and I'll see you there. What is an accredited investor? How do you become an accredited investor? Why should you become an accredited investor, and what are the benefits to being so?